My research is bullish, so I'm more inclined to want to put money to work here. I am expecting the market to move higher. I do not think, based on my key indicators, that the market is going to have a large and long duration down move to allow us the opportunity that we may have had last March. So we want to put money to work. With that being said, we are getting opportunities now almost regularly, intraday or intra-week, when some news story comes out or something enters the investment landscape that causes the market to be volatile, for there to be rotations. This can be viewed very opportunistically to allow us to put money to work, either if we're just going into the market altogether, or if we want to buy particular areas of the market. So the areas that we've been focusing on in the sector level is financials, materials, industrials, parts of consumer discretionary, energy, and parts of technology. You could also take advantage of buying some of the individual names that are within our favorite sectors that our research likes. So again, we want to use market action opportunistically because we are looking for the market to move higher. So to summarize here is yes, we are looking for opportunities still to put money to work. This is always an interesting question because each individual has to take into account their own risk tolerance and their own mandates as well. But to broadly talk about a couple of techniques which an investor can do, let's go through those real quick. So number one, buying a put option. Buying a put option is benefits because the value of the put option will go higher when either the market, a sector, or stock, whatever the put is written on, goes down in value. So that helps us when we have markets when they go down in price. So we can do put options. Some investors may ask, well, what should I buy a put option on? I would ask you the question, what are your current exposures? Do you own large cap stocks? Do you own big S&P 500 sectors? Do you own small and mid cap individual names? Depending on what your portfolio currently has in it, will likely determine the best put option that we may want to buy for our hedging purposes. So it's something you may want to think about. The second strategy we can employ to partially offset potential downside risk is something that's called covered call writing. What that is that we can sell a call option on a position that we currently own. And what we do in that is we take in income or premium. And what that is this partially will hedge us if our instrument or our individual stock goes down in value. It will partially be offset by us taking in this income. It's not my preferred method because since I am bullish and I think that markets and individual stocks will be going higher, if we write a call option and what we own goes up too fast, we may have to surrender our instrument. So you may want to look into that a little bit more, but that is a second technique. The third technique is to buy an ETF that has what we call inverse performance. There are now ETFs out there where the value of the ETF will go higher if the instrument that's underneath it, if it's the S&P 500, if it's a sector, if it's a fixed income product, if their value goes down. So right there is if your instrument goes down, your ETF will go up in value. So there are a lot of instruments out there that provide this type of exposure, which you can employ to help hedge. And lastly, I would just say is if you are nervous and markets are getting sloppy or you're getting really, really concerned, you can just get smaller, meaning you can sell something and get that cash and wait for a better buying opportunity. Yes, I'm aware that there may be tax implications for you, but it's always better to have money to pay tax than to lose money. So we have an expression on Wall Street that bulls and bears make money and pigs don't. So there may be a time when actual selling may actually be a good strategy. I think it really depends on what's going on. So those are the categories, the techniques that we would recommend right now from an easy standpoint. It's always a great question. It always is dependent upon you on what your goals are and what your risk tolerance is. So let's go through this and we'll lay out a couple of different ways. Number one, my research has been constructive for the energy space. So number one, I am supporting having exposure in the energy area. Now, if you're an investor that does not want to actively manage individual securities, there are several very good ETF products that you can take advantage of being involved with the energy, and one would be the Energy Spider. There are also some other ETF instruments which get a little bit more granular. So instead of getting broad-based sector, you can get to different parts of the energy sector, be it equipment and services or more the majors. So that's one way to do this. Another way to play it is now trying to get into the individual stocks. Now, in my quantitative single stock selection model, there are many energy names that my research likes. A few of my favorites to try to capture the expectation that crude prices may be going higher are in the E&P area. Some of my favorite names in there are Marathon, Hess, and Diamondback, and Occidental Petroleum. Those are a couple of my favorites, although there are many more. The other thing that I like here is if that's a little bit too much risk there, because these stocks tend to move a lot, either up or down. There's other ways to play. We can play something that's a little more conservative and has a dividend yield, which would be the integrateds. And the two names in there that look particularly interesting are ExxonMobil and Chevron. Lastly, I think an interesting way for any portfolio, for any investor who either A, wants to play energy or has part of their portfolio in either bonds, other instruments that create income. Because within the energy sector, we have an area called the MLPs or the pipelines. Right now, there's a handful of these stocks which pay dividend yields north of 6%, which to me is a very attractive yield based on where interest rates are today. You can also get some exposure to energy stocks going higher. So there's a couple of names in there that I particularly like. The first one would be Williams. The second one would be Kinder Morgan. So there's a couple of different ways to play this, but I think the important thing is our research is constructive. We do want to have exposure, and we are looking for there to be some gains in this space. So let's look about what's most important and valuable to you, and let's get that exposure.